Welcome back to Journey to XRP. Over the last few weeks, the market has been flooded with noise, sharp price moves, bold claims, and now AI-driven predictions being pushed as if they're answers. And a lot of people are asking the same question quietly, even if they won't admit it publicly. Can an AI model actually help us understand what's happening with XRP right now? Or is this just another layer of confidence wrapped around uncertainty? That's what we're going to unpack today. Yeah, but not in the way most videos are doing it. This is not about letting an AI tell you where price is going. That mindset is lazy and it's dangerous. AI does not see the future. It analyzes patterns, probabilities, and historical behavior. The value isn't in the output. It's in whether the framework makes sense when you pressure test it against reality. And right now, reality is uncomfortable for a lot of people. Markets are not behaving the way late cycle narratives promised. Liquidity is tight, volatility is elevated, confidence is fragile, and when those conditions exist, humans look for authority, something that sounds intelligent enough to trust. AI fits that psychological gap perfectly. But here's the hard truth most creators won't say out loud. If you ask bad questions, you get bad answers, no matter how advanced the model is. An AI trained on historical data will always lean toward historical averages. That can be useful or completely misleading, depending on how you use it. So instead of asking an AI what XRP will do next, the real question is this: what does the broader system look like right now, and does it support expansion or contraction? Because price is a symptom, not the cause. Today's breakdown is about using AI analysis as a lens, not a signal. We're going to look at how models like Grok interpret market phases, how that aligns with historical cycles, and where those conclusions overlap or conflict with macro liquidity, regulation, and institutional behavior. If you're expecting hype, price targets, or shortcuts, this isn't your video. If you're looking to understand why markets feel stuck, why timing keeps disappointing people, and why XRP's role can't be evaluated the same way as most speculative assets, then you need to stay until the end. Because the biggest risk right now isn't missing a pump. It's misreading the phase we're in and acting emotionally when the environment demands patience and structure. Most people lose money not because they were wrong about the asset, but because they were wrong about the timing and the context. And AI doesn't fix that by default. It only helps if you already understand what matters. Before we even bring XRP back into the conversation, we need to deal with the broader market reality, because ignoring context is how people fool themselves. Markets don't move based on hope, and they definitely don't move because an AI model sounds confident. They move based on liquidity, risk appetite, and policy, and right now, all three are under pressure. From a structural point of view, the crypto market has gone through a clear risk-off transition. Whether people want to label it a bear market or not is almost irrelevant. What matters is that capital has pulled back meaningfully from recent highs, volatility has increased, and momentum has broken down across multiple time frames. Those are not opinions, those are observable conditions. Bitcoin, like it or not, still acts as the liquidity anchor for the entire digital asset market. When Bitcoin struggles to sustain upside, it signals tighter conditions for everything else downstream. That's why AI models often start with Bitcoin when analyzing cycles. Not because Bitcoin is perfect, but because it reflects where capital is willing to sit when uncertainty rises. When Grok looks at previous cycles, it doesn't see narratives or headlines. It sees sequences: expansion, excess, contraction, stabilization. Historically, after a significant peak, markets don't immediately resume upward movement, and they spend time digesting, unwinding leverage, and resetting expectations. That process is rarely fast, and it's almost never comfortable. Macro conditions matter here more than most people admit. Interest rates remain restrictive relative to the last decade. Liquidity injections are limited. Central banks are cautious, not accommodative. Japan tightening policy, global bond markets under stress, and uneven economic data all feed into a reduced appetite for speculative risk. Crypto doesn't get a free pass from that environment. This is why it's misleading when people point to isolated bullish developments and assume they override macro pressure. One positive headline does not reverse a liquidity cycle. AI models tend to weight this correctly because they're not emotionally attached to single data points. So when an AI suggests that markets are in a contraction or consolidation phase, that doesn't mean collapse is guaranteed. It means the system is not currently optimized for aggressive expansion. That distinction matters. Most losses happen when people confuse not bullish with panic, or worse, confuse temporary bounces with structural reversals. At this stage of the cycle, patience is not a personality trait, it's a risk management decision. The environment is forcing participants to slow down, reassess, and stop assuming that every dip is an opportunity. Sometimes the opportunity is simply not losing capital while conditions reset, now that we've grounded ourselves in what the broader market is actually doing. This is where the gap between retail thinking and institutional behavior becomes impossible to ignore. Most retail participants are conditioned to react. Institutions are trained to wait. And that difference is exactly why AI-driven frameworks tend to sound boring to traders but sensible to allocators. When an institution looks at a market like crypto during a contraction phase, the first question is not, when does price go up? It's, is the underlying system progressing while price is under pressure? If the answer is yes, then time becomes an ally, not an enemy. AI models like Grok implicitly follow this logic because they evaluate structure over emotion. They recognize that periods of weak price action often coincide with heavy back-end development, custody solutions, compliance standards, regulatory engagement, and infrastructure upgrades. None of that excites retail traders, but all of it determines where capital flows later. Liquidity is the central variable. In expansion phases, liquidity chases narratives. In contraction phases, liquidity demands proof. That's why speculative assets without a clear function tend to bleed the hardest, while assets tied to infrastructure quietly survive. This isn't about favoritism, it's about capital preservation. Retail often mistakes volatility for opportunity. Institutions view volatility as a cost. When volatility is high and liquidity is constrained, professional capital either hedges or waits. It does not aggressively chase upside, no matter how compelling the story sounds. AI models reflect this by projecting longer stabilization periods rather than immediate reversals. Another critical point here is regulation. Institutions cannot move ahead of legal clarity. They position around it. That means building exposure indirectly, testing systems, and preparing operationally long before price reflects any of that work. This is why waiting feels frustrating. Progress is happening, but not in a way that shows up on a chart. What most people miss is that bear and consolidation phases are not pauses in development. They are filters. Weak narratives, over-leveraged participants, and poorly designed projects get washed out. What remains is infrastructure that can support scale when conditions change. This is also where AI analysis is most useful, not for telling you when to buy or sell, but for reminding you that markets move in regimes. Acting like every regime is the same is how people exhaust themselves and their capital. Now that we've established how institutions and smart capital interpret this phase, the next question is obvious. Where does XRP fit into this structure specifically, and why does its role look different from most of the market? Now let's bring the focus back to XRP, because this is where a lot of people either oversimplify the story or misunderstand it entirely. XRP is often judged through the same speculative lens as other digital assets, and that's a mistake. Not because XRP is better, but because it is designed for a different function within the financial system. XRP's relevance is tied to liquidity movement, settlement efficiency, and interoperability, not short-term excitement. That distinction matters more during contraction phases than during bull markets. When liquidity is abundant, everything rises together. When liquidity tightens, assets with a defined role tend to hold strategic interest, even if price action looks unimpressive. From an institutional perspective, XRP sits closer to financial plumbing than financial speculation. The XRP ledger is built for speed, cost efficiency, and reliability in value transfer. That makes it a candidate for bridging liquidity between systems, especially as tokenization and cross-border settlement become more regulated and standardized. This is where indirect comparisons help. Bitcoin is increasingly treated as a macro asset and collateral layer. Ethereum functions as programmable settlement and smart contract infrastructure. XRP is positioned as a liquidity bridge, a mechanism, not a narrative. These roles can coexist. They don't cancel each other out, and they don't need to compete directly. AI models tend to recognize this distinction because they track usage patterns and system evolution rather than social sentiment. When Grok evaluates XRP, it doesn't assume exponential hype-driven growth. It highlights periods where XRP historically responds to shifts in liquidity conditions and regulatory clarity rather than pure speculation. That's why regulation matters disproportionately for XRP. Institutions do not adopt settlement rails they can't legally integrate. Progress here shows up slowly, often invisibly, through pilots, partnerships, and back-end readiness, not price spikes. Retail investors often interpret that silence as failure. Institutions interpret it as preparation. The danger for individuals is expecting XRP to behave like a meme asset during a period when the market is explicitly de-risking. That expectation creates frustration and poor decision-making. XRP's thesis plays out over systems and cycles, not weeks. Understanding this doesn't guarantee outcomes. It simply aligns expectations with reality. XRP's potential depends on execution, adoption, and macro alignment, not on whether the market feels excited this month. With that context in place, the final piece is mindset, how to approach this phase without forcing conclusions, and how to avoid turning analysis into emotional conviction. That's where we'll close. So the real question at this point isn't whether an AI model is bullish or bearish on XRP. That framing misses the point. The more important question is whether you understand the phase the market is in and whether your behavior matches that reality. Tools like Grok can be useful when they're treated as analytical frameworks, not oracles. They help highlight historical tendencies, duration ranges, and structural patterns, but they don't remove uncertainty. Anyone using AI outputs as instructions rather than context is outsourcing responsibility, and markets punish that mindset quickly. XRP remains a long-term thesis tied to financial infrastructure, regulatory clarity, and liquidity efficiency. That kind of thesis doesn't move on hype cycles. It moves when systems are ready and when capital has a reason to flow through them. That often looks slow, frustrating, and anticlimactic right up until it isn't. This phase rewards restraint. It rewards people who can sit with uncertainty without forcing trades or narratives. It punishes impatience, overconfidence, and the need to always feel right. That's true whether you're using AI, technical analysis, or macro data. If conditions improve, liquidity returns, and regulatory frameworks solidify, XRP will reflect that in time. If those things don't happen, then the thesis must be reevaluated honestly. Both outcomes require discipline, not belief. And that's where we'll leave it. This content is for educational purposes only and is not financial advice. Always do your own research and consult a licensed financial professional before making any investment decisions. If you want to go deeper into another angle, regulation, liquidity cycles, or institutional adoption, let me know.